Hello, everybody. I'm Kathy Harrigan. Maybe you've heard of me. I've been at the Columbia Business School for 40 years, and I am the first Henry R. Kravis Professor of Business Leadership. My doctorate is from Harvard Business School, but that was a long time ago. Since that time, I've written a few books, served on some corporate boards, and taught 11 different electives. Currently, I am teaching in the Executive MBA program, primarily. I teach corporate strategy elective about how companies best grow. It's the opposite of what you would take in an entrepreneurship course, because I'm dealing with companies that must constantly reinvent themselves and justify their existence and that of their corporate family. I also teach the turnaround management elective. I took it over from John Whitney when he retired. And that's the paper that I will be presenting this evening. Thank you. Now, first of all, I have to explain that this work was done with one of my students, Brian Wing. He hasn't given me a high sign, so I don't know if he's on this seminar tonight or not. He did a lot of the field work. We also have in the turnaround management seminar a variety of professional managers who come through and share their stories. And we kind of compiled all of these insights that I'm going to share with you in a colloquium that was held, an academic colloquium sponsored by the Strategic Management Review. It was on the topic of corporate renewal, which is a problem, of course, for a mature company. And it was held at Columbia Business School, as a matter of fact. James Gorman was our keynote speaker, and his remarks are also available when the Strategic Management Review issue comes out. It's an entire issue on this topic of corporate renewal. Quite honestly, most of the people who were presenting papers were talking about the idea of divestiture. And since I'm one of the editors for this particular issue, I said, well, we need a paper about turnarounds then. You know, we're missing a part of the story. So the first thing I want you to understand is this is motivated by the assumption that if you can fix your operating problems, you will generate more value than you would get by divesting those operations. Or another popular topic in this seminar was what they call resource redeployment, which is academic speak for, well, you can't divest it and get money for it. So maybe you can take a lot of the resources and suck them out and put them someplace else in the company. Now, I put in the example of the private equity company because that's what Brian was willing to help me with. He was intrigued by this. And I would point out that in a way, private equity companies are kind of an anomaly because publicly traded companies are really kind of stuck with the businesses that are in their corporate portfolio. Things can go sour as a result of things that are beyond their control. Private equity companies try very hard not to invest in industries that we would consider to be toxic. Indeed, their due diligence team works really hard to find industries that have the good kind of companies to acquire. And remember, private equity companies are made up of contacts and their deal flow. So they have a kind of a matching potential to them, that they know who's out there that's an available manager, and they also know companies that need good management. Now, even in some instances, private equity companies that are known to take on problem children businesses, they will oftentimes be approached by managers who will have their own candidates to bring in, and they'll look for some shared funding from the private equity companies. The private equity company that's probably best known for this approach would be Clayton, Dubilier and Rice, which is where former CEOs go if they're not yet quite ready to go and play golf. Then they go and they look for the opportunity to go turn around some companies that are in the portfolio. I know that other big private equity companies like Blackstone have their own in-house training and cadre for people to go around and basically tune up the companies that are in their portfolio, okay? Now, understand why it is that publicly traded companies with shareholders are not so good at this. They're facing a real bias toward quick results. Their investors want good results, and if there's bad news, they're not very well tolerated. So there's sort of like a contagion effect that happens. All of a sudden, the industry may have difficulty in getting capital from the providers of financing when they want to be able to do something to improve a company. And so there's a lot of problems with being in an industry that has a reputation of having some problem performers. Also, we have a natural bias towards the entrepreneurial or the growth end of the spectrum. Frankly, managers in charge of those kinds of businesses get a lot more freedom, they get a lot more cash than do companies that are in mature or declining demand industries. And so managers are reticent, if they're in a publicly traded company, to get involved in doing a turnaround. They would rather divest it, make this somebody else's problem, and walk away from that. It creates a real buying opportunity for a private equity company, because they're so eager in the publicly traded company to get rid of the problem child that they will not get a fair price. They leave money on the table in the transaction. So the obvious thing, private equity owners buy low, they do their turnarounds, and then they monetize them on the other end. It's excellent on their side that they're private, because that way they don't have to meet quarterly reports on what's going on. They can just sort of disappear from the terrain until they're ready to talk about monetizing it at the end of their turnaround. And here is something that I found really kind of interesting as we kind of sorted through all of the examples we were able to collect. It really does seem like the private equity owners are better able to find value in these assets that the publicly traded companies were so eager to get rid of them. And part of that may be the methodology that private equity companies use in approaching the turnaround process. Instead of assuming that things are bad, they go in and do the big inquisition on every possible aspect of why the company does what it does, what are the relationships between the different activities that are performed inside the company. And they also are willing, once they've got their growth path in mind, they're willing to invest in the assets that might be necessary to take that business to the next level. And one of the most important assets that they spend time analyzing has to do with the content of a customer relationship. And you'll see that their approach is diametrically opposite to what the academic literature says about how companies tend to approach the turnaround problem. In a nutshell, very quickly, the literature says that companies in a turnaround situation will first retrench, which means they will sell off a bunch of stuff and, just to get a lot of cash together. That's because they don't have the cash on hand to deal with the problem of a turnaround. It comes up and bites them in the butt from behind. They weren't expecting that. And then once they come up with an idea that might successfully make the company survive, then they're willing to kind of go, oh, all right, well, maybe we can afford to make some more investments in this business that we've turned around. By contrast, the private equity company has transformational investments that it is willing to make. They have a budget. They understand the need to make these changes, to bring these companies to realizing their full potential. And they don't start out by retrenching, where the literature says recovery comes second. I would say that private equity companies make recovery first. They actually work on how they can raise prices, please the customers more, find services or other goods to sell to make those customers more satisfied. And if anything, increase the stickiness of using their product. And this is all part and parcel of the fact that the way that a private equity company looks at this investment opportunity, they know what they can afford to do. They know what they can afford to spend. They don't spend excessively. And then they realize on the other side that these businesses are going to carry a lot of debt. This will enable them to capture any kind of managerial slack, which is sort of academic wise for saying, well, you know, a little sloppiness, a little cushion here and there. There are no cushions on this, okay? So they decide exactly what they're going to invest in. Are they going to bring in the experts that are at their fingertips in the so-called virtual Rolodex or not? And the other thing is that private equity teams, when they're doing a turnaround, they all have skin in the game. Terrible phrase. But the fact of the matter is that in economics, we talk about that as the principal agent issue, that managers may mess around and do something else unless they are similarly incentivized. And so you're using the upside of successfully being able to accomplish the turnaround as a way of motivating managers to toe the line and do the things that are expected. And that brings me to another interesting thing that we discovered as a result of comparing all of these companies' experiences. You have to change the employees' expectations and the way that they behave, and make sure that they understand the fundamental business model and their role in creating value for the company. This may mean retraining them if they're not doing their job correctly, which is why the private equity companies tend to have experts in each of the functional areas that they can bring in if necessary to make these changes to ensure that these companies will be able to do the job of operations correctly. The other thing that was kind of interesting was the extreme effort that is put into detailing all the drivers of profitability. Invariably, you'll see an example here as we do customer triage that the sales force is going to lose their freedom to haggle and negotiate and throw in all kinds of spiffs and other incentives to their customers in order to be able to capture a deal. In essence, they are financing their customers, and this is something which private equity companies seem to be extremely good at ferreting out, as they actually do decide which customers deserve to be served, which customers you basically kind of don't make them stay close to you, you drive them away. All right, so now again, the variance here in how the publicly traded company versus the private equity company. The publicly traded company doesn't do an effective turnaround because they would rather make it somebody else's problem if they can move on to something else. Also, they hate to be reporting losses in a quarter or two or a year or two. You know, one of my trick questions in the turnaround class is how long does it take to do an effective turnaround? And the answer may well be 3 years. Get used to it. Well, nobody wants to be stuck doing a turnaround for 3 years and reporting losses. That's not what managers think of as doing. Well, they also may not have the right kind of people. These experts that I talked about that are available, that the private equity companies can use at their discretion to retrain employees who don't know how to do their job correctly. Also, in many companies, there is nobody who has ever had the experience before of being in a really competitive market where you actually could lose your market share and your resources are not used effectively. So the combination of the talent shortfall plus this attitudinal problem of not wanting to do a turnaround because you are publicly traded and people are looking at you in a fishbowl makes it kind of a difficult proposition for a publicly traded company. So again, the literature says, and we found it is consistent, that publicly traded companies are going to use retrenchment as opposed to other kinds of approaches to be able to turn a company around or at least redeploy those resources someplace else. They're probably going to destroy the value of the resource because they make a knee-jerk reaction on monetizing the assets, and therefore they lose a lot of value for the shareholder. By contrast, the private equity company first looks for all the opportunities to increase cash flow in the businesses and the assets that they've inherited in the bundle of assets they have. And they are particularly interested in finding out exactly how strong the customer relationship is and how profitable is that. So therefore, you understand that they may make some divestitures of little assets that are really not core to the strategy. But if they actually choose to divest something that is of more substantial in the business, they're going to work it in such a way that they will get the highest possible price. And they will be very crafty about not giving away which businesses they're interested in and which businesses they might be willing to part with. They're going to act or take the attitude that there's gold in all of them there hills. There's a buck in all those weeds, and all you have to do is be willing to dig around in there and find those valuable opportunities. So in contrast to a publicly traded company, the private equity turnaround has the willingness to take the time, provide the resources, and look at the problem from a root cause point of view in a way that the publicly traded company will not be willing to subsidize. And so that's where it is so important for the private equity company to be able to reach out to these various specialists to help them do a quick check on the effectiveness of a functional area. They'll send an entire SWAT team of their experts in, each of them checking their own specialty within operations. They will work to discover the attractiveness of various products, to find the opportunity for premium prices. They will also look for practices that are actually costing money. And then, of course, by the time that they want to actually monetize this investment, after they've gone through the process of rehabilitating the operations and making those resources generate as much cash as possible, then they bring in the professional managers who may or may not stay with the company after it has been monetized. They will be willing to stay for 18 months, and then they'll move on to the next big event and participate, typically incentivized with some equity that managers share, that we always talk about when we discuss how should we divide up the spoils. All right, now this was something that I found was kind of interesting too about the guys who drove the car off the road in the first place into the ditch. In a publicly traded company, if you are successful in turning around a business, you either stay with it or you will get promoted, but you're more likely to remain in the corporate family. Private equity companies don't have that kind of loyalty. They tend to monetize their successes, and if necessary, and here we make a distinction which Brian refers to as manager now or versus the manager that is right. Okay, the manager that's right may not be available now, in which case you'll have an inadequate manager, the same person who put the company into a difficulty in the first place, but they'll phone in the plays from the emergency team or from the restructuring office or from somebody at the private equity company. As soon as they can find the right manager to take it to the monetization event, they will. But it may be necessary to initialize the turnaround process with that same dolt that put the company into trouble in the first place. Okay, so then one of the things that is important to remember in concluding is that these relationships have value, and the private equity companies are much more persistent in ascertaining which relationships and which resources actually have value. They're not as likely to trash everything as the publicly traded companies will do. And of course, they know then that if they do their turnaround correctly, they will make much better returns than you would get by liquidating or by divesting or something like that. Of course, here's the problem. There is a high risk that the publicly traded company is going to sell off their business for a fire sale price because they need cash, and they probably need cash to fund some of those growth businesses. So it's very likely that the businesses that get divested that could have undergone a turnaround because are actually undervalued just because the publicly traded company just creates a vision, a strategic plan that causes them to no longer fit. All right, so therefore, it is possible to use resources far more effectively than a publicly traded company in their corporate family might do, but they're unwilling to make the effort because they think it takes too long. It hurts their reputation. It isn't a sexy job. It's a boring job. And therefore they lose a lot of opportunity, which the private equity companies are perfectly happy to snap up. Okay, and that's my pitch. Do we have any questions?
Thank you so much, Professor Harrigan. We do.
I do. Great.
Okay. Okay. We have a few questions. One is, can you elaborate on the similarities and differences between a private equity and activist, institutional investor?
Oh, geez.
Yeah, who takes.
We're going to be talking about that. We're going to be talking about that in the corporate growth class, which starts in about a month, which I teach in the summertime. Yes, corporate shareholder activists. We look on that as an asset class. The people who agitate for changes in how a company is operated are usually motivated by some compensation that they will trade upward in the improvement, or they are underwritten by providers of capital who are the creditors of a company. And so as a result of that, the shareholder activists oftentimes have available to them a lot of great resources for doing the analysis, but their position is sort of putting a wedge into this entire transaction, that they're going to come in to motivate the managers to make particular adjustments. It could be to divest something. It could be whatever they think will give them the fastest value. Shareholder activist demands are not necessarily the kinds of demands that are good for a company in the long term. And here I'm going to get controversy like crazy. The board is lighting up already as all the activists in the audience are saying, how dare you say we don't provide value? Well, they provide value to the people who hired them. It's a kind of arbitrage. It's another opportunity to make money. Okay.